Hello everyone, in this video I'm going to walk you through a rather simple numerical example that will show you how you can figure out a project's or a firm's cost of equity. Now, in a previous video I've explained that estimating cost of equity is essentially all about using the capital asset pricing model. Specifically, cost of equity is the same as the rate of return that equity holders require on their equity investments. And the capital asset pricing model says that the rate of return that equity holders should expect or require should be at least equal to the risk-free rate plus the risk that equity holders are bearing as captured by the equity beta times the expected return on the market minus the risk-free rate, where this portion of the capital asset pricing model is referred to as the expected market risk premium, EMRP. Now, for the purposes of this video and maybe a few videos that follow, what I'm going to assume is that the firm is entirely equity financed. In other words, if you have assets on the left-hand side, then all these assets are funded with equity. In other words, there is no debt. The implication of that is that when we will be calculating cost of equity, essentially, cost of equity will be the same as the firm's cost of capital. Why? Because equity is the only source of capital. There is no debt. Moreover, we're going to assume that the firm is planning on remaining 100% equity financed, so debt is going to continue to be zero. And if the firm is planning on making any additional investments, it is in assets which are as risky as the assets that the firm already has in place. These are very, very important assumptions. I will explain the implications of these in just a minute, but please keep these two assumptions in mind as we work through our example. So here is the example. So suppose you are the financial manager of KitchenWorks, which is a fast food restaurant, and it has no debt. In other words, it's 100% equity financed. Now, you know that the stock is publicly traded and it has a beta of 1.5. The risk-free rate is given as 3% and the expected market risk premium is 7%. So already you can note that you are given some of the inputs for the capital asset pricing model. Now, suppose you as the financial manager are thinking that it's time to expand the restaurant and you're considering financing the expansion using equity. All right, so these are two very, very important aspects of this example. So if the firm had some assets, we know that they were initially funded entirely with equity that was given. Moreover, you're now thinking of increasing the number of assets, right? Because you're thinking of expanding the restaurant. So the assets are going to go up, and the way you are going to finance this increase in assets is using equity. Notice that you are going to continue to remain debt-free. So we're being consistent with one of the assumptions that we made earlier. And secondly, you're expanding the restaurant. This means that if you had some tables or chairs or a refrigerator or a freezer, you're just expanding your existing asset base, which means that the additional assets that you are investing in are going to have the same risk profile as your existing assets. So now the question is, what is the equity holders' required rate of return and cost of equity? And a second question, which is kind of related, is what is the rate at which you, who are the financial manager of KitchenWorks, should discount the expected cash flows from this expansion? Let's tackle the first one. Well, equity holders' required rate of return can be calculated using the capital asset pricing model. Why? Because in this particular case, equity holders are facing a certain amount of risk, which is captured by their equity beta of 1.5. And capital asset pricing model says that the rate of return that equity holders should require on their capital or their equity should be equal to the risk-free rate, which is 3%, plus beta, which is 1.5 times the expected market risk premium, which is given as 7%. If you do this math, you will arrive at a number of 13.5%. So that is the cost of equity. That is also the rate of return that equity holders will require. Why? Because when the financial manager will ask these equity holders, hey, equity holders, please give me your equity to invest in these assets, equity holders will say, okay, well, we need 13.5% because the moment we are giving our equity to you, we are foregoing the opportunity to earn 13.5% on other assets that are out there that are as risky. In other words, that have a beta of 1.5 as well. The second aspect of the question was, what is the rate at which the financial manager, which is you, should discount the cash flows from the expansion project? The answer is, again, 13.5%. Why? Because that is the cost of capital. That is what your equity holders are foregoing when they are giving you their hard-earned money. So you need to make sure that the investment that you are doing makes sense even after you are discounting the cash flows at 13.5%. In other words, it has a positive NPV at a discount rate of 13.5%. Now, at this point, I do want to emphasize the importance of the two assumptions that we made. First, we are assuming that the firm is going to remain equity funded. If this assumption weren't true, in other words, let's suppose that while the firm was 100% equity funded so far, the firm now decided, or you decided as the financial manager, that you're going to raise some debt to fund that expansion. Well, then you cannot use the beta of 1.5 to estimate the cost of equity. Again, this is something that I will talk about in more detail in a subsequent video. But basically, when you introduce debt into the picture, it makes equity holders' claims riskier because cash flows to debt holders go first and then whatever remains goes to the equity holders. So generally speaking, as debt increases, it makes equity holders' claims riskier, which means that equity beta tends to go up. All that to say that if currently the beta is 1.5 and therefore currently equity holders' required rate of return or their cost of equity is 13.5%, we can only use that as cost of equity if the firm continues to remain 100% equity funded. In other words, the capital structure does not change. So that is the first assumption. Secondly, even if the firm continues to remain 100% equity funded, but you as a financial manager now decide that you want to take money from your equity holders and now invest in assets that don't have anything to do with kitchen works. Maybe you are trying to open up like an automotive shop, or maybe you're opening up a grocery store or investing in some other forms of assets. Well, those are very different types of assets, which means that the risk that your equity holders will be exposed to will be different from the kind of risk they are exposed to right now, given that all their money is in assets which are in kitchen works. The point being that we would no longer be able to use the same 1.5 that exists right now to plug into the capital asset pricing model and to calculate the cost of equity and hence the cost of capital. Specifically, we would need to know the riskiness of the new assets in which the new equity is going, which is why we wanted to make the assumption that the new investment that the firm is undertaking is simply an expansion of existing assets, which means that we can use this 1.5 into our capital asset pricing model. If you found this video useful, click the like button and subscribe to the channel. And feel free to ask any questions using the comment section. Happy learning.